as is the deal market as well. So let's welcome on board Sanjay Nayar, partner and CEO at KKR India, and talk about all the pockets that they're finding exciting, especially after the recent investment into Reliance Retail. Sanjay, hi, good morning. Great to speak with you. Sanjay, check after check. First Jio, now Reliance Retail. What's next from the Reliance table?
I have no idea about the Reliance table, but I think the kind of funds being deployed by private equity funds, I think just shows the confidence in the long-term growth story, because I don't think it's an accident that one fund has invested. So many funds have invested. It just tells you that there's a great time to be investing. And I think obviously funds like us are looking through the trough and seeing some very, very secure trends in the future. Of course, it's in the future a little bit, given what we are going through in terms of the pandemic. But I would say it doesn't take away from the basic structural changes that are going on in the economy and in consumer behavior, in digitization. So there's a lot going on, and I think that's what these investments speak to, frankly.
Sure. Sanjay, so let's talk about Reliance Retail first. Why Reliance Retail? How is it that you value Reliance Retail right now? And when one talks about pure valuations, now that it's the largest player within the unlisted retail universe, aren't the valuations of Reliance Retail slightly suppressed?
Well, again, I don't think Aisha, it's fair to sort of comment on the valuation, but the way we looked at Reliance Retail is, it's frankly a great play on what could be, or well, it already is the largest retailer, but I think becomes an incredibly large company in kind of an omnichannel play. And I think if you really bank on two big trends that we are looking at, I think one is the digitization that's going on in the economy. And I think the second one is the shift from unorganized to organized retail. So if you look at their current spread of 12,000 odd stores, they're obviously going to go places much more than that in the next 4 or 5 years. If you look at the fact that there is the connectivity with Jio that they have in terms of e-commerce, and finally, if you look at the strategy which Reliance is going to adopt, has already started and experimenting, is to bring in the small size merchants, what we guys call the corner shops, or the Kiranas. I think that becomes a very powerful story, because what you're doing then is that you're banking on the shift from organized to organized. So all of us now go to the stores, or I'm sure when you get a time on the weekend, you go shop in the stores, even if it's grocery, convenience. You've seen the success of electronics and fashion. Then you have obviously the e-commerce flow that comes in, and finally you still have the old habits that change hard. You still order things from the Kirana shop. And, the Kirana shop is extremely efficient. They come and deliver stuff to you. They probably bill you 2 weeks later. So the strategy here, from what we understand and what we have sort of diligence, is not to disintermediate the Kirana, but is to engulf the Kirana into the same ecosystem and to empower them with their technology and the supply chain. So I think you're playing to all these three trends. And I think that's how we looked at this, at this investment, frankly.
Sure. PE investments typically work in two ways, Sanjay. A, you pump in the money, you watch the baby grow, and then you exit when it decides to list. So before that, actually. And sometimes it's also with a vision of a future buyout. Do you think the Reliance Retail business model is good for perhaps a buyout in future?
We haven't. I mean, look, here, it's a small minority stake. We are really backing the management team and Mr. Ambani's vision and the tremendous execution prowess. In a minority stake like this, I don't think we are banking on an exit of that nature, frankly, if you ask me. If we control a company, then that's a different issue. We can talk about it. I think this can just be a massive Indian company playing to the growth in the retail sector. And you look at markets like Indonesia, when you cross $2,000 per capita GDP, retail just explodes, and all kinds of format explode. So I think, Aisha, the way we would look at this, I think a stake of under 1.5% is not something that we would think about how to exit. Whether it's going to be bought out or not, I think A, too early, and B, we're not the decision makers here to think about it that way. But think of it this way. I mean, you can have a listed entity in India of a huge size that plays to all these trends. And, you've seen them in China, you've seen them in Indonesia, you've seen them in Japan. So why not India?
Sanjay, good morning. Nikunj also joining in. Are you hoping that in the overall scheme of things, just like the Jio got some strategic partners, Reliance will also be able to get some strategic partners to make the retail business go to a different level? Or irrespective of whether there is strategic partner, no strategic partner, you are very happy with what you've invested?
Yeah, look, we're extremely pleased. I mean, frankly, we are backing the strategic, which is Reliance itself. So I don't know, in a physical retail, in a market like India, with the Jio initiative already off the ground and a strategy to combine the Kirana shops and to empower them, given the amount of supply chain they've built out in terms of warehouses, cold chain, farm to fork, I don't see, why this is not the strategic itself. So I don't know where you're going with the question, but we are actually in a way backing a strategic that's in India, trying to cater to the Indian middle class and changing behaviors, and has put a massive amount of investment already in technology and supply chain. So I think that's the play here, and I think we are backing the strategic already.
Unlike Jio, Sanjay, where you have an investment, retail, some would say, is a much more complex business. There are lots of state and central challenges. There are different structures in terms of what you can do and how much you can invest. How do you see those regulatory hurdles coming on the way for growth for Reliance? Because like you said, Reliance Retail is now trying to attempt both ends after future retail acquisition on ground and after what they're doing on the mobile platform. It's a completely different thing. So they're trying to attack both the ends of the market or address both the ends of the market.
Yeah, but just to be clear, I mean, there's an Indian company, so I don't think there is any regulations to sort of worry about here. And secondly, I think future gets them, yes, I think a lot of supply chain benefits, but frankly, at the front end, Reliance already has 12,000 stores. So I think an Indian company based out of India, grown in India, and if they execute the right way with all the stuff we spoke without being repetitive, I mean, I don't see any challenges on the regulatory front, at least.
Sure. Sanjay, let's move out of Reliance Retail now and let's talk about chemicals and specialty, pharma, etc. as well. Post JB...
Aisha, I lost you.
Yeah. Post JB Chemicals, Sanjay, which, judging by the Q1 earnings, we understand why you're excited about the company. And now we're hearing about interest in granules as well. Help us understand your interest in specialty chemicals as well as pharmaceuticals. And if you could talk a little bit about granules, whether you're interested or not, where is the process exactly headed?
Look, great question to which I have pretty weak answers, unfortunately. I won't comment on companies where we haven't invested, like granules. But I would say broadly, pharma has been a sector that we've been focused for a long time. If you remember, we invested in Gland Pharma many years ago. It was quite a successful exit, and the entrepreneur is still there and doing a fantastic job. I think pharma in India is one of those domestic areas that is very resilient. Is getting a lot of tailwinds now with COVID as well. And I think in the case of JB, we have 3-4 very, very strong products, which are doing very well. And they speak to the growth in the chronics area. I would say in JB, we're extremely excited. Obviously, can't comment, it's a listed entity. But I would just say that the pharma sector has great secular tailwinds. I also think that we need to focus on APIs. that is clearly an area which in fact makes us a bit more self-reliant and, as the Prime Minister says, a bit more Atmanirbhar. I think that's an area we need to develop as an alternate supply chain within the country. I think the government is putting out a lot of policies and support around that. So that's another area that we should be sort of focusing on. I think a lot of our peer funds are looking at these companies again. So my view is that there's a lot to be done in the pharma API sector, domestic formulations, good institutional high quality money that comes in, gives it more ammunition for capex, distribution, better governance, good management. I think these are all positives for, consolidating the pharma sector, making it bigger, making it more self-reliant for the country as a whole. On specialty chemicals, frankly, that's an area we haven't gone in, but we're clearly something to look for, because it again, in a way, is a combination of science and low-cost manufacturing, which India is pretty good at. So we're excited about both these sectors, honestly. And of course, the third area is technology in general. We've been a late starter, but it's never too late. We will definitely look for technology companies, and that plays to the whole investment in Jio and Reliance Retail, which is you're playing to consumption upgrade and you're playing to digital transformation. So I think that's an area we have to stay focused on. And so that's really the sort of three areas, frankly, Isha, that we're looking at.
Sure. I also want to talk about CG Power, which you recently exited. Now there seems to be a huge turnaround story which is playing out. And it seems that Murugappa promoters are buying it out. Judging by what they've done with Tube Investments, is there a misstart feeling? Do you feel that you exited a little too soon?
Yeah, so just to be clear, I mean, that's something that is from our credit shop. It's not from the private equity side. It's something that was ownership of shares on the invocation of a pledge because of a default of a loan. That's determined pretty much by the credit committee and by our trustees, frankly. I mean, I don't think that there is a feeling of remorse of being left out. I think it was just a loan that turned pretty sour, and frankly, whatever recovery we got. We also need to, just clean up, which we are doing, and then just move on in life, frankly.
Sanjay, where do you think syndicated debt is moving? You got one side where corporates are not spending or expanding, and where you have corporates who understand the ability to leverage their balance sheet are actually de-leveraging. A classic case here is Reliance. I'm using that for illustrative purposes. Since you are also in the business of giving syndicated debt, where do you think that end of the market is moving? Because that's an harbinger or more like a canary in a coal mine to understand what is the shape of the economy.
Great question, Nikunj. I mean, this is something that I personally think a lot. I personally have a lot of interest in just understanding corporate bonds of all kinds, infrastructure, municipality, corporate debt, whatever. And, it's tricky, frankly. The syndicated debt market is actually quite shut, if you ask me right now. After the IL&FS crisis, all the different accidents, is shut. But, you're absolutely right. No emerging economy can grow unless you have a really robust secondary debt market, which is, I think, what you're referring to. Now, there are two things that you need. You've had lots and lots of committees around this, so I don't think we need another committee. But what you need is the issuers and the investors. I think issuers also are quite lined up. It doesn't have to be the AAA people. Actually, the secondary debt market in every country is the issuers really are the people who need the capital, and you need investors who can price that risk reward. So AA's, single A's, triple B's, whatever. So I think the mechanisms are well established. There are the clearing agencies, there is listing options, all that is there. I think what you really need, Nikunj, to get this thing going, it's not for the banks to buy. You need secondary investors that typically in the rest of the world are insurance companies, pension funds, yes, maybe bank treasuries, high net worth families. you need long-term capital to come in, which can price risk smartly and get this market going. So I think this is being talked about a lot, so I don't want to repeat again. But I think the government is now looking very seriously at converging some of the regulations along with the help of SEBI and others, so that we can have, clarity of rules such that insurance and pension money can really come into this market. Otherwise, I think you have the backbone is ready. There is the infrastructure that is ready. There is listing rules that are pretty clear. There's a futures market now. So there's all the trappings that you need to have a robust secondary debt market is there. So I think this is another point on Atmanirbhar, if you ask me. I keep saying this. If you want to be Atmanirbhar, you can't depend only on dollar debt all the time. You've got to develop local currency debt. And for that, you need local currency, long duration savings to be unlocked.
Such a great point. That true Atmanirbharta also means that we need to be having a very vibrant debt market. You want money from outside, but you want to be Atmanirbhar for everything else. It's not going to work in a long term. So Sanjay, I'm going to ask my next question to Sanjay the banker. Now there is a disenchantment towards banks, and that's a global phenomenon. From JP Morgan to HSBC to Citibank to ICICI Bank, all banks are getting smashed to levels which have even gone below the GFC crisis in some cases. Is this kind of a stepmotherly treatment which banks are receiving? Somewhere there are NPA concerns, somewhere there are disruptive concerns, somewhere there are general concerns about what financial tech would do. Do you think banks will struggle and banks will not be able to regain their mojo because of what is happening in the world?
Yeah. Look, I think in India, banks, I think, have been traditionally overvalued, if you ask me. The private sector banks, they were able to grab a lot of market share. They were smarter on technology, smarter on risk. Now, I think with the kind of situation we are in, I think everybody is trying to figure out what's the level of risk in all the banks. I think the public sector banks have taken the biggest knock, which is, in a way, unfortunate, but there could be pretty attractive values there now. But for that to become interesting, I think you need, again, a word that I've used before, you need to not privatize them, but you need to privatize their management in a way, or the governance. And I think there's enough reports on that. Again, I hope, and I think the government is looking seriously at how to make these public sector banks consolidated, which is going on, and drive governance in a much more free and a kind of a private sector manner, but not, I'm again not saying privatization. It's about privatizing their management and governance. I think if that happens, the public sector, I think, should really do well, because they have the spread, they drive financial inclusion, they can still look at term loans. That's, I think, quite critical. On the private sector banks, I think they've done a really good job in the last decade or two. I think the challenge for them is going to be, to be able to price risk. I mean, they have to take a lot more risk. And because of the expense of public sector banks, who are now picking up on service. I mean, look at the SBI story on YONO and stuff like that. And this cross-selling SBI is doing of their insurance business through Banca. I think the private sector banks have had a pretty easy ride to grab market share from the public sector, and they'll have to now obviously pick up the game on taking credit risk, whether it's consumer or corporate or financial institutions, because what this last 2 years has shown is they haven't taken that much risk, frankly. And they've got really the cream of the business. So I think that is now getting corrected. And the thing that's going to save everybody here, I think, is everyone's raising capital, which is a very smart thing to do. I don't have rough numbers on NPAs and all that, but broadly, I think the banking system is actually in pretty good shape if you assume that there's not a disastrous outcome after the moratorium and things are as predicted. I think banks have raised a lot of money already, Nikun, so I don't think there is any more danger to the system. And prices are obviously much lower than what they were earlier. So hopefully from here, we will see the right growth. I think NBFCs, frankly, have shrunk the NBFC sector. It's not easy to get leverage for them. So I think very specialized NBFCs, either asset-based or fintech or really well-run consumer NBFCs will probably be the few survivors, and then I think they will flourish quite a bit because they will use technology, fintech, better risk management. So look, I think it's playing out nicely. Give it another year. the landscape will be much clearer.
Sanjay, great to have you on the show today, and thanks for so candidly answering all of our questions.
Thank you, Nikunj. Thank you, Aisha.